started happening in big numbers, decided that it was easier to kind of just go bankrupt than to start paying. I mean, they couldn't just afford paying on all of those CDSs. So you can see the system was very, very intertwined. It was very complicated. The instruments themselves were quite complicated. No one really knew how to price them. No one could figure out what the correct price for those CDOs was, right? Because there were no models. Everything was new. The risks kept changing. It was a big mess. That started with the feeding frenzy. Of course, it's always on Wall Street because, you know, you have to make money. If you don't make money, what happens to you? You're an investment bank. Let me rephrase this question. Let me make it a little bit more interesting. Do you think there were smart guys on Wall Street who predicted this? Who predicted that these CDOs and large numbers and these risks could have eventually turned into something really, really bad? Yes. And who listened to them, or who did they tell? Why no one listened?
This managers were kept to the side. They were doing the...
Yes. Do you think it's affordable for a CEO of a large investment bank to say, yeah, you're right, this whole mortgage industry is getting really, really risky, so although everybody else on the street is doing this, we're going to stop. While people are still making money from this, right? Do you think they can afford to say that? No, because these investment banks are public companies, right? And if you don't make the profit that your shareholders expect, your shareholders are going to go somewhere else, right? So everybody had to ride the bubble until the bubble burst. Well, there was one investment bank that got out, but that investment bank is known for its sneaky rates. What is that investment? Yes, Goldman Sachs. So when Max goes to work on Wall Street, he's going to know where to look for information. Right? Okay, so this is sort of a very brief description of what happened. Very brief, because it was a very complicated story, right? Should we blame academics for this? Weren't they supposed to be sitting in their warm offices, looking at this, going, oh my God, I need to tell someone? Or calling their congressman, trying to get them to stop this mess before it burst? Go ahead.
No, some of them did try, but when they went to the news to say, we gotta stop doing this, everyone, the other 5 or 6 economists over there would laugh at them.
Right. There were people who tried, definitely. Not only that, there were people who were saying this is going to turn into a big disaster. But you know what? People say this all the time, right? What's his name? What's this guy's name from NYU? Rubini, right? Nouriel Rubini. He's been saying we're going to get into a recession for the past 20 years. Yes, there have been a couple of recessions during that time. He's not always right. So when do you start listening to them? Right? What is that day when an economist comes to a TV show and says, okay, we need to stop doing something because we're going to get ourselves in a big crisis, if this economist has been saying this for the past 20 years? Right? When do you start listening to them? Well, actually, economists were predicting that something like this could happen in general, not in particular about this crisis, but in general. These situations with bank runs, with liquidity spirals, with mass mortgage defaults, that has all been modeled, written up, and published in academic journals now over the past 30 or so years. So had someone in the government read those academic journals, and they rarely do because, well, we were going to talk about why in a second, people would have probably been more prepared, or better prepared for this. So let's talk about some of these. The first study that I wanted to mention here is by Douglas Diamond and Philip Dybvig. And those are not just random economists from the middle of nowhere. Doug Diamond is at the University of Chicago, which is one of the leading schools in economics and finance, right? And Dybvig is at Washington University in St. Louis, which is also one of the leading schools. So when they publish something, when they create a theory, and those are not, 5-page opinion pieces for the Wall Street Journal, those are very heavy math-based theories. So when they create a theory, or when they describe something, people should listen, right? So what they did, as far back as 1983, and JP means Journal of Political Economy, one of the most important journals of economics. So what they did is they created a model of bank runs, right? Bank runs, and as a conclusion to their model, they said in order to prevent bank runs, the government needs to introduce deposit insurance. Now, they were a couple of decades late with that, right? Because governments all over the world, well, at least in the Western countries, introduced deposit insurance way earlier than 1983, right? Most of them did this after the Great Depression, because the Great Depression actually resulted from massive bank runs. During this last recession that we're going to call the Great Recession, there were not that many bank runs, right? How many bank runs did we have during the last recession, during this past crisis? The recent one. One. And it wasn't in here, it was in Britain, right? And it was kind of like not a big deal kind of bank run. Yes, it was a Northern Rock situation. So we didn't really have that many bank runs this time, exactly because of deposit insurance. Now let's make sure that everybody understands what deposit insurance means. It is. You know, if you have a bank account, you're protected, right? If your bank defaults, goes bankrupt, the banker runs away or whatever, the government will give you up to, I think it's actually $200,000 now, right? Up to $200,000 back. This is deposit insurance. It is created for exact purpose of not having bank runs. And the bank run is when a lot of people come to the bank on the same day and want their money back, right? And the bank doesn't have it, even if the bank is extremely healthy and in perfect shape. Because why does the bank not have this money for all of its depositors on the same day?
It only keeps a certain small percentage of cash, actual cash, and it's...
Exactly. The bank's business is to collect money from people who don't need it right now and to give it to those that do, right? So on any particular day, it may not have all of the money that it has collected in the past, right? So that's absolutely normal. Now, sometimes people get panicky and all come back to the bank to get the money on the same day. That's a bank run. And of course, if you can think about it, one bank run creates a wave of bank runs because people who don't have money with this particular bank see a huge line at this particular bank and decide that, well, it's probably better to go to mine and get the money out of it before everybody else goes and gets their money out of it, right? So bank runs are extremely contagious. Now, why are we talking about this paper? We didn't have that many bank runs here in this last crisis. Or did we? We didn't have exact bank runs, but we did have quasi-bank runs. And what am I talking about? Massive quasi-bank runs. We had, yes?
People setting off their investment?
Yeah. We had a lot of quasi-bank runs happening with Wall Street firms, right? People were trying to take their money back from everywhere on Wall Street, right? And there was no government support for that. There's no official government insurance of investments, right? Because your investments are kind of like your own risk. If you won't invest, if you don't want to invest in risky assets, then buy government T-bills, right? So there's no insurance for that. But the government in the US was actually providing some quasi-deposit insurance for investment banks. And that is called a very famous word, or two words actually, I don't know how to spell that. Jordan.
Bailout?
Yes. What do you think a bailout is? A bailout is quasi-deposit insurance, right? A big bank gets into trouble, people start withdrawing their investments in large amounts, the bank struggles to pay that cash back, the government comes in and bails it out. That's deposit insurance. What was the first big investment bank that they bailed out in 2008, in March of 2008? It was Bear Stearns, right? Bear Stearns collapsed first. And the government didn't let it collapse. The government actually bailed it out and merged it with... Yes. And if you remember, March, April, May, June, July, those months, we still had a serious crisis in our hands, but it was evolving rather slowly. And then at the end of August, what happened? At the end of August, we had a big quasi-bank run that wasn't bailed